price leads to higher wages. All right, here we go. Non-farm payrolls for the month of December on our jobs report. Way hot, 256,000. Wow. What a shocker. 212,000 on last week's revised 227,000. But let's look at 2 weeks worth. If we get 2 weeks worth of revisions, we are looking at down 8,000, down 8,000. Now, 256, we have to see when that comps to. That would be the comp of March of last year when it was 310,000, which means it would be the second best, basically going back to that point. Now, let's look at some of the important internals, shall we? Average hourly earnings up 0.3, up 0.3. We break that up 0.4. Up 0.4 was what we had been running. And if you look at the average hourly earnings year over year, we broke the 0.4. We're now down to 3.9, which in some ways may be good news. I'd like to see people make more wages, but we know that we've been feeding the beast with regard to income and higher prices. 3.9 equates to April of last year. To find a lower, you have to go all the way back to March, which I think is pretty interesting all in all. If we look at average hourly work week, 34.3. 34.3 basically has been where it has been most of last year. If we look at the underemployment rate, or U6, 62.5, exactly as expected. I'm sorry. That was the labor force participation rate, 62.5, and it has been hovering at that level, Joe, 62.5. 62.6 was October of last year. Last year's complete high water mark was 62.7. The lowest of last year was 62.5, just to put a face on 62.5. And now the underemployment rate, known as U6, 7.5%. That is way down from 7.8, which became revised to 7.7. 7.5 would be the lowest going back to June of last year. So pretty decent news there. The market speaks for itself. What did it concentrate on? All the numbers I brought out: drop in wages, the underemployment rate, the actual employment rate, U3, and it looked at the jobs creation at 256,000. We zoomed up all the way up to 477 plus on a 10. We zoomed up all the way near 5% in a 30-year bond, literally 4.998. And that is something to pay very close attention to, because we haven't traded over 5% in a 30-year bond since the fall of 2023. And we see the pre-opening equity markets took a huge ding. So we need to monitor. Not only are we not seeing what Fed officials really thought would be a slower jobs market, as you pointed out, we see sticky inflation, and much of the Fed speak last week was, well, we think 1 to 2 cuts is still in the cards. If the year develops as we think it will, meaning conforming to dot plots, this doesn't look like it's dot plotting very normally against what we saw in the last meeting. Back to the panel.
Okay, thanks, Rick.